If you think the next economy is still 10 years away, I think you're already behind. Because while most people are still debating what the future might look like, companies are already spending money to build it. You can see it in AI budgets, you can see it in data centers, you can see it in how money is starting to move. And you can definitely see it in housing, where mortgage rates are reminding everyone that real life does not pause just because people are waiting for better conditions. The next economy is not a theory anymore. It's showing up in balance sheets, infrastructure plans, and everyday financial decisions. The next economy isn't coming, it's already being built. I'm Kyle Grimshaw, and this is the Texas Market Brief. Good morning and welcome back. I'm Kyle Grimshaw with the Grimshaw Home Group. Today is Monday, June 29th, 2026. If you're a young professional, homeowner, investor, entrepreneur, or just someone trying to understand where the economy is headed, you're in the right place. Last Friday, we talked about how America is changing faster than most people realize. Today, I want to build on that idea because over the last couple of weeks, we've gotten more proof that the next economy is no longer just a prediction. It's entering its build phase. And when an economy enters its build phase, the questions change. It's no longer just what sounds exciting. Now it becomes what actually scales, what creates value, what gets funded, and what gets built, and who gets left behind if they don't adapt. Let's jump in. When ChatGPT first exploded onto the scene, the conversation was simple. Who has the smartest AI? Who has the flashiest model? Who has the biggest demo? And who can make the most headlines? Today, that conversation is changing. Now businesses are asking a much more serious question. Who has the most affordable AI? Who can deploy it efficiently? Who can control the costs? And who can actually make money using it? That's a major shift. And honestly, it was always going to happen. Every new technology goes through this cycle. First comes the hype, then comes adoption, then comes the bill. And we are entering the bill stage because using AI at scale is not cheap. It takes computing power, infrastructure, electricity, talent, and it takes training. And increasingly, it takes ongoing usage costs that are harder for companies to predict than traditional software subscriptions. And that matters because once CFOs start looking at the AI the same way they look at the payroll, cloud spend, or real estate, the conversation gets more disciplined. This is the moment where AI starts getting judged less like magic and more like a business line. And that's healthy because the companies that win the next phase of AI may not be the ones with the biggest model. They may be the ones with the best economics, the most discipline, the ones that can deliver 80 or 90% of the value at a fraction of the cost, the ones that can lower the price load and the power load, the ones that can reduce token burn, the ones that can help companies get real output instead of just expensive experimentation. That's how markets mature. And in my opinion, this is actually a sign that AI is becoming more real, not less. When markets shift from hype to efficiency, it usually means it's growing up. Now, let's bring this back to people because one of the biggest conversations happening in business right now is not whether AI will replace everyone tomorrow. It's more practical than that. It's whether workers know how to use it well enough to stay competitive. That's the real divide I see forming. Not simply jobs with AI and jobs without AI, but people who know how to work alongside these tools and people who don't. More employers are beginning to view AI as a baseline workplace skill, not because AI replaces human judgment, but because it can enhance productivity when used correctly. Think about what spreadsheets did for accountants, what email did for communication, and what smartphones did for business. AI is starting to move into that category. Not a gimmick, not a side experiment, a real tool. And here's what I think gets missed. The labor market impact so far has been more uneven than catastrophic. That's important because a lot of people hear AI and assume the immediate result is mass unemployment. That has not really been the story so far. The more immediate risk looks like pressure on certain roles, especially junior or highly repeatable white collar work, while people with adaptable skills, practical judgment, and domain expertise still have leverage. So, my view is this: the people who learn to work alongside AI will likely outperform the people who pretend it doesn't exist. That's not fear, that's adaptation. And adaptation is what every generation eventually gets tested on. The hard truth is that refusing to learn the tool does not protect you from the tool. It usually just means someone else learns it first. Now, let's talk about money. Not Bitcoin, not meme trades, not the daily price swings, the system itself. Banks, fintech companies, payment providers, and regulators are all moving toward a faster, more digital financial architecture. Stablecoins, instant settlement, tokenized assets, real-time payments, these are no longer fringe ideas. They are becoming part of the financial conversation in a much more serious way. Why? Because moving money today is still often slower and more expensive than moving information. And that gap creates opportunity. If money can move faster, settle faster, clear faster, and travel across borders with less friction, the institutions that build those rails are not just improving convenience. They are building core infrastructure, and that is the bigger story. The real fight is not just over which asset wins attention. The real fight is over who owns the rails, who owns the wallets, who owns the payment networks, who controls the on-ramps and the off-ramps, and who becomes the default layer that commerce runs through. That's where the real long-term power is. Now, on the positive side, this can make finance better, faster payments, lower friction, better treasury management, and more efficient settlement. That's real, but there are also real risk, because faster digital money also raises questions about fraud, privacy, surveillance, consumer protection, and what happens when people assume a payment product is as safe as a bank account when it may not be. So again, this is not science fiction. This is institutional competition over the next version of financial plumbing. And the winners here may shape how the commerce works for the next decade. Now, let's talk about housing, because while all this future talk matters, people still have to live in the present. And the present still has mortgage rates. As of June 25th, the average 30-year fixed mortgage rate was 6.49%. That's not a collapse, it's not relief, and that's not the big rate reset that a lot of buyers have been hoping for. It's just more evidence that rates have stayed relatively steady and that this market is still asking people to make decisions in an environment that feels expensive. And here's my opinion. One of the biggest mistakes people make is putting their entire life on pause while waiting for the perfect market. Perfect markets barely exist. People still get married, families still grow, jobs change, businesses still relocate, homes still wear out, life still moves on. Housing demand does not disappear just because financial situations become more expensive. It's just more selective, more cautious, and more emotionally exhausting. That's why I think the better strategy is not to build your life around fantasy rate scenarios. It's to understand your own numbers, your timeline, and your own flexibility. Because good housing decisions usually come from clarity, not wishful thinking. Trying to time the economy perfectly is a great way to stay frozen. And in Texas especially, where long-term growth still matters, staying frozen can carry its own costs. Let's bring this home. Texas is in a unique position. AI companies are expanding here, infrastructure is growing here, businesses are still relocating here, and population growth remains strong. And the state still has more runway than a lot of the country. That is the good news. But growth creates responsibility. And this is the part I think a lot of leaders still underestimate. The next economy is not just digital, it's physical too. It needs power, land, water, skilled labor, housing, transmission, roads, logistics, and local capacity. And Texas is already being pushed on all of these fronts. We are seeing serious pressure around large load power demand from data centers. We are seeing ongoing infrastructure questions, and we are seeing a massive long-term water need hanging over the state. So yes, Texas has a real opportunity to be one of the biggest winners of the next economy, but let's be honest about what that takes. You do not become the home of the next economy just by announcing projects. You become the home of the next economy by supporting them without breaking the systems everyone else depends on. That means enough housing so workers can actually live near opportunity. It means reliable power so growth does not turn into grid stress. It means water planning that takes future demand seriously. It means a skilled workforce that includes electricians, builders, HVAC techs, engineers, healthcare workers, software devs, teachers, and entrepreneurs. Texas absolutely can win this next chapter, but the state has to earn it operationally, not just market it politically. Here's the question I've been asking myself. What if we're still thinking about this the wrong way? Most people ask, what job will AI replace? I think the better question is, what skills become more valuable in an AI-powered economy? Most people ask, when will mortgage rates fall? I think the better question is, how do I make smart financial decisions even if rates stay higher than what I want? Most people ask, what will the future look like? I think the better question is, what can I do today that makes me stronger no matter which version of the future shows up? Because the next economy is not waiting for permission, it's already being built. And in my opinion, the people who win from here are not just the smartest people. They're the people who adapt early, that take action. The people who can connect technology to real value. The people who stay grounded in reality while everyone else is either panicking or procrastinating. The future will reward the people who adapt before they are forced to. I want to hear from you. If you could learn one new skill over the next 5 years, what would it be? Artificial intelligence, investing, a skilled trade, starting a business, or something else entirely? Leave a comment and tell me why. I'd love to hear your perspective. And if you found today's episode helpful, make sure to subscribe. Share this episode with someone who's interested in where Texas, America, and the economy are headed next. I'm Kyle Grimshaw with the Grimshaw Home Group. Thank you for joining me for another episode of the Texas Market Brief. Have a great week, and I'll see you on Wednesday.